Following my previous two videos, one of which talking about the most monopolistic companies all around the planet, and the other one talking about the top 10 companies with the most unshakable territorial moats in their respective countries, I want to talk to you guys today about a different kind of monopoly. And these companies are the stock exchange operators. Let's talk about their financial and trading profiles. Number one, Intercontinental Exchange Incorporated, listed under the ticker ICE in the New York Stock Exchange. This is the giant behind the New York Stock Exchange, NYSE, Global Energy Futures, and Mortgage Tech Networks. It processes millions of complex derivatives contracts daily, alongside the world's largest blue-chip corporate listings. It generates over $9.9 billion in consolidated net revenue. Its high-efficiency operational model yields a 50% GAAP operating margin, leading to $3.3 billion in net income. It carries noticeable long-term debt resulting from structural tech acquisitions like data giant Black Knight. However, assets are backed by critical data systems and clearinghouse equity, protecting its strong investment-grade leverage profile. It produces highly secure liquidity, converting operating success into $4.7 billion in operating cash flow and $4.2 billion in pure free cash flow. This fuels steady share buybacks and dividend growth. Number two, Nasdaq Incorporated, trading under the ticker NDAQ in the Nasdaq. The global capital for technology listings, SaaS-driven exchange software, and index licensing. It powers billions of electronic messages daily for hyperscale tech organizations like Apple, Nvidia, and Microsoft. Intentionally insulated from basic volume fluctuations. Over half of its revenue is driven by highly predictable software subscription fees, SaaS, and index license fees from products tracking the Nasdaq 100. Exceptionally lean, dominated by intangible intellectual property, software platforms, and proprietary financial technology rather than brick-and-mortar installations. It is a highly efficient conversion of operating profit into free cash flow. Because its platforms scale digitally with minimal capital expenditure, CapEx, excess cash flows go straight to long-term dividend growth. Number three, CBOE Global Markets Incorporated, traded under the symbol CBOE. This is the undisputed global pioneer of options, derivatives, and short-term volatility trading. A primary beneficiary of the structural explosion in options trading, managing a record average daily volume exceeding 18.4 million contracts. This is heavily driven by SPX, index options, and the modern phenomenon of zero DTE, 0 days to expiration options. Experiencing massive organic momentum, tracking quarterly net revenues of over $725 million, which is a 29% surge year over year. It scales with an astonishing adjusted operating margin of 72.4%, generating explosive earnings per share growth. It holds an incredibly dynamic liquid structure. Capital architecture is primarily structured around high-speed options, execution, matching systems, and clearinghouse cash reserves paired with negligible relative debt. A cash-generating machine, CBOE efficiently translates options volume into immediate liquidity, returning hundreds of millions of dollars to shareholders via dividends and tactical share buybacks. Number 4. Hong Kong Exchanges and Clearing Limited, traded in the OTC under the ticker HKXCY, or on the Hong Kong stock listing 0388, the primary international pipeline connecting mainland Chinese capital directly with international global investors. Driven by unique cross-border stock connect channels directly linking Hong Kong liquidity pools to Shanghai and Shenzhen, it pulls in 27.1 billion Hong Kong dollars in core revenue. Its legendary structural efficiency delivers a massive EBITDA of over 22 billion of Hong Kong dollars, translating to an EBITDA margin near 80% and a net profit of 17.8 billion of Hong Kong dollars. It functions as a fortress clearinghouse. It holds massive participant margin deposits and settlement collateral over $269 billion of Hong Kong dollars in structured liabilities matched symmetrically by high liquid assets with zero traditional long-term corporate debt. Cash generation is robust and predictable. HKEX maintains an aggressive shareholder-first stance, distributing an annual dividend payout matching a 90% payout ratio. Number 5. Japan Exchange Group Incorporated, TSE 8697, the absolute monopoly operator of the Tokyo Stock Exchange and Osaka derivatives systems. Benefiting heavily from the structural re-rating of Japanese equities by foreign institutions, tracking expected cash equity average daily volume near 7.5 trillion yen, brought in 198.7 billion yen in operating revenue, sending net income up sharply to 79.1 billion yen. This delivers an elite corporate return of equity ROE of 23.1%. Its balance sheet, pristine and cash rich, featuring minimal structural liabilities, substantial cash reserves, and exceptionally liquidity ratios. It's a cash flow statement, steady, predictable cash inflows. JPX leverages this health to run an authorized 20 billion yen share buyback program alongside the dedicated 81% dividend payout ratio. Number 6. The London Stock Exchange Group PLC, LSEG, the ticker, the ultimate financial data subscription engine. Its trading volume and scale. Trading execution on the floor is a minor part of the business. LSEG's primary engine is its massive data and analytics segment. FTSE Russell, its income statement, pulls in immense subscription revenues, delivering a reported EBITDA of 4.36 billion pounds and operating profits expanding to 2.12 billion pounds. Its balance sheet geared heavily toward long-term enterprise indexes and Refinity enterprise financial terminals. Subscription assets. Strategic debt is intentionally deployed to scale deep enterprises infrastructure cloud partnerships, such as its long-term architecture integration with Microsoft. Its cash flow statement, elite cash generation capabilities. LSEG aggressively returns capital via a multi-year 2.1 billion pound share buyback program rolling actively throughout February 2027. Number 7. Mainland China, Shanghai SSE and Shenzhen SZSE exchanges, the massive internal engines of the world's second largest economy. The Shanghai Stock Exchange and Shenzhen Stock Exchange are state-managed institutions and are not directly listed as public stocks themselves. To invest in the financial volume of mainland China, investors use the primary listed investment banks, asset managers, and market makers that capture this volume. Its trading volume and scale. Enormous domestic, retail, and institutional scale. The Shanghai Composite Index trades actively past the 4,000 mark, with combined daily turnover across Shanghai and Shenzhen regularly clearing 800 billion renminbi to 1 trillion renminbi. The structural mechanics, highly domestic and manufacturing, tech-heavy. Shanghai features massive state-owned enterprises and banks, while Shenzhen acts as China's tech startup incubator, similar to the US Nasdaq. Its cash flow and payout structure. Capital flows inside these systems are heavily guided by national value-up policies and divided initiatives. For example, major market practices like CITIC channel massive volume into consistent cash dividends, regularly returning payouts like 5.2 renminbi per 10 shares to investors. Now, is investing in exchange operators a good idea? Investing in global exchange operators is generally considered a sophisticated defensive and premium portfolio strategy. You are effectively acting as the landlord or toll booth collector of global capitalism. What are the advantages and why it works? The volatility advantage. Most businesses fear market crashes and economic uncertainty. Exchange operators, especially options-heavy giants like CBOE and ACE, thrive on it. Panic creates volume, and because exchanges get paid per transaction contract, sudden spikes in volatility cause their transaction revenues to surge. They have impenetrable moats. Building a meaningful competitor to the New York Stock Exchange, the Tokyo Stock Exchange, and the CBOE is practically impossible due to liquidity network effects. Traders naturally congregate where the buyers and sellers already exist. Next, revenue of sticky data. They possess the exclusive rights to sell real-time price feeds. Algorithmic trading desks, Bloomberg terminals, and hedge funds must purchase this data to function, giving exchanges massive pricing power. What are the risks? The operational risks, the threat of sideways, boredom. The ultimate risk to a stock exchange isn't a sharp market crash, it's a boring flat market. If a market drifts sideways for a long period with no volatility, retail and institutional trading volumes dry up, immediately denting execution fees. There are regulatory fee pressures. Because these exchanges function as a critical regional economic infrastructure, their fee structure face constant scrutiny from government watchdogs like the SEC or regional ministries, meaning they cannot easily raise transaction prices at will. As a result, the absence of 10x rocket growth. These are mature, institutional blue chips. They offer remarkable dividend compounders and immense safety, but they will not provide the rapid astronomical growth curves of early-stage software or AI startups. In economics, stock market exchanges are classic examples of natural monopolies within their respective countries. If you look around the globe, most countries have exactly one major dominant exchange that handles nearly all of their equity trading. For example, the Japan Exchange Group in Japan, the Toronto Stock Exchange in Canada, or the ASX in Australia. Exchanges achieve and maintain these monopolies because of two powerful economic forces: the network effect and liquidity consolidation. Now, why stock exchanges become monopolies? Number one, the power of two-sided network effects. A stock exchange is a financial marketplace that connects two distinct groups: buyers, which are the investors, and sellers, which are the companies looking for capital. Buyers naturally want to go to the exchange that has the most sellers, because that's where they can find the widest variety of stocks to buy. Sellers, which are the companies, want to list their stock on the exchange that has the most buyers, because that's where they can raise the most money. This creates a massive snowball effect. Once an exchange becomes the biggest in a country, it acts like a giant magnet. It becomes almost impossible for a brand new competitor to start from scratch, because they have no buyers to attract companies and no companies to attract buyers. And number two, the liquidity that breeds liquidity. In finance, liquidity refers to how quickly and easily you can buy or sell an asset without drastically changing its price. If trading volume is split across 5 different small exchanges in one country, liquidity becomes fragmented. This makes it more expensive and slower for institutional investors to execute big trades. To get the best and fairest prices, everyone naturally forces their money into the single largest pool of cash. Consequently, the largest exchange swallows the rest. Which one is the big exception? The United States. The United States is the main exception to the strict one monopoly rule, but even there, it is actually a duopoly, which is two massive players controlling everything. Instead of one exchange, the US has the New York Stock Exchange, the NYSE, and the Nasdaq. The total US stock market volume is split between the New York Stock Exchange with about 40 to 45% of market share, and it is focused on blue chips and financials, and the Nasdaq, which holds about 40 to 45% of market share, which is focused on tech like Apple, Nvidia, and AI companies. They compete fiercely for company listings, but they still operate like localized monopolies over their own listed stocks. If you want to trade the shares of Apple, you must route through the Nasdaq ecosystem. If you want to trade Walmart, you route through the New York Stock Exchange. What this means for you as an investor? Because these companies hold massive legal and structural monopolies in their respective countries, investing in their stock, like buying shares of Intercontinental, Nasdaq, CBOE, or JPX, gives you ownership in a business with a nearly unbreakable protective wall. They do not have to worry about a trendy new startup coming along next week and stealing their customers, because you cannot copy or steal a multi-trillion-dollar pool of global liquidity overnight. That is why they enjoy incredibly high profit margins, often north of 50 to 70% operating margins, that standard businesses can only dream of. Now, if you guys are interested in this kind of companies, IAR is the iShares US Broker Dealers and Security Exchanges ETF. IAR is a highly targeted play on the capital markets infrastructure itself. It owns the companies that make money when people trade, invest, launch IPOs, and clear transactions. AEA tracks the Dow Jones US Select Investment Services Index. It effectively captures the Wall Street transaction machine, including investment banks, retail brokerages, crypto/digital trading platforms, and major public stock exchanges. The net asset under management, AUM, for AEA is about 1.4 billion bucks. Its expense ratio, 38 basis points, and the yield versus the trading yield, 0.96% versus 1.1%. Brokerage and market makers tend to reward shareholders via aggressive share buybacks over massive dividend payouts. Its price to earnings, PE, ratio sits at about 23.6. Its portfolio concentration. The fund holds 34 positions, with the top 10 positions representing roughly 72% of the total fund weight. The portfolio is split into two main buckets: the investment banking and brokerages for about 67%, and financial exchanges and data, which makes up about 32%. Here is what the heavily top-weighted top 10 looks like. Number one, GS, Goldman Sachs Group Incorporated, that makes up about 20.5%, elite investment banking, institutional trading, merging and acquisition advisory. Number two, MS, which is Morgan Stanley, with about 17%, which is an institutional trading asset and wealth manager. Number three, Schwab, SCHW, Charles Schwab Corporation, makes up about 10%. It's a mass market really brokerage. SCHW, Charles Schwab Corporation, 9.8%, mass market retail brokerage, custody services, wealth management. Next, Hood, Robinhood Markets Incorporated, 4.4%, nearly retail trading options, crypto retail, and market share. Next, MSCI Incorporated with about 4.3%, critical financial data, investment tools, DEX licensing. Following MCO, Moody's Corporation with about 4.2%, which is a corporate debt, credit rankings, and financial risk analytics. SPGI, S&P Global Incorporated, that makes up about 4% of market benchmarks, financial data intelligence. Following NDAQ, which is NASDAQ Incorporated, 3.73% equity exchange operator and institutional SaaS technology. ACE, Intercontinental Exchange, makes up about 3.7%, operates the New York Stock Exchange, clearinghouses, and mortgage data networks. And finally, IBKR, Interactive Brokers Group, with about 3.5%. It is a high-volume professional retail/institutional electronic brokerage. Note, Coinbase, COIN, also sits just outside or floating near the bottom of this top tier, depending on minor weight shift, adding a direct exposure to digital asset trading volume. Exchanges such as ACE and NASDAQ market makers profit from volume and movement, not just upward trends. Whether markets are soaring or experiencing a sharp correction, heavy trading volumes translate directly to transaction fees, clearing fees, and margin interest. Goldman Sachs, Morgan Stanley suffer when corporations freeze up. However, when interest rate environments stabilize, pent-up corporate demand for mergers, acquisitions, and initial public offerings, IPOs, creates a surge in high-margin investment banking fees. Platforms like Charles Schwab, Interactive Brokers, and Robinhood continue to capture huge asset inflows as retail trading and self-directed investing become structurally permanent global habits. Investment banks are notoriously cyclical and fickle. A prolonged bear market or an unexpected economic shock can completely freeze corporate deal-making pipelines, instantly chalking off earnings for the top 37% of the fund, Goldman Sachs and Morgan Stanley. Regulatory and fee compression risks. Pure play brokerages face constant regulatory scrutiny regarding payment for order flow and margin lending requirements. Additionally, the industry-wide race to zero commission trading forces these companies to constantly find alternative ways to monetize users. Heavy top weight dependencies. And now we got to the bonus, guys. The over-the-counter OTC, the OTC market in the United States, it's a decentralized network of broker-dealers who facilitate equity and debt trading directly between the two parties, bypassing centralized physical exchanges like the New York Stock Exchange and the Nasdaq. Instead of an exchange floor, trades are executed electronically. The OTC market is the primary venue for thousands of securities that do not meet the stringent financial, regulatory, or listing fee requirements of major national exchanges. This includes early-stage microcaps, distressed entities, and notably massive foreign conglomerates such as Roche, Nestlé, or Adidas that choose to list in the US via American Depository Receipts, ADRs, without undergoing. The vast majority of OTC equity trading is organized by a single private entity, OTC Markets Group Incorporated. They structure the marketplace into tiered categories based on the quality of the frequency of the company's financial disclosures, which serves to help investors assess information risk. OTCQX, the best market, the premium tier. It features strict financial standards, requires audited financial reports, and companies cannot be in bankruptcy or be considered penny stocks. Many established international giants trade here. Next, OTCQB, the venture market, designed for entrepreneurial and development stage companies. Firms must be current in their reporting and undergo an annual management certification, but the financial hurdles are lower than OTCQX. Next, OTCID, the basic market, SEC registration, a modern structural tier launched to establish a firm baseline for transparent corporate disclosures within the over-the-counter equities landscape. And finally, Pink Limited, the open market, the lowest tier with no financial thresholds, contains a highly speculative mix of companies that may be current, limited, or completely dark regarding their financial reporting. OTC Markets Group Incorporated, interestingly, the company that operates this entire infrastructure is itself a publicly traded corporation. It trades of its own premier tier under the ticker symbol OTCM. From a business model perspective, OTCM operates like a capital efficiency toll booth for the OTC ecosystem. It generates revenue through three core business segments: corporate services, fees paid by companies to be listed and tracked on the OTCQX, OTCQB, and OTCID tiers. It makes money through market data licensing, subscription revenues generated by selling the real-time data feeds, pricing engines, and compliance tools generated by its platform to broker-dealers, institutions, and financial platform. Transaction-based connectivity and execution services for broker-dealers utilizing their alternative trading systems. Historically, OTC Markets Group has operated as a highly profitable, cash-generative business with virtually no long-term debt and a strong tradition of returning capital to shareholders via consistent quarterly dividends, special dividends, and opportunistic share buybacks. The company's performance has been bolstered by structural upgrades such as deployment of the OTCRD framework and expanding international trading volumes. It has got a market capitalization in the range between 610 million to 624 million bucks. Got a gross revenue in the trailing 12 months in the range of 124 to 129 million bucks. Income in the range of 31 to 32 million bucks in the trailing 12 months, with a net profit margin of nearly 25%. And earnings per share, EPS, over the past 12 months of about 2.59 to 2.66 bucks. The price to earnings, which is the PE ratio, sits at about 19 to 20x. Its balance sheet strength, with a strong cash revenue, about 45 million bucks, negligible to zero debt obligation. Recent quarterly performance, Q1 ended March 31st. The financial results demonstrate accelerated trading volumes and structural revenue growth across core business lines. Its gross revenue increased 14% year over year to $34.8 million, up from 30.4 million bucks in the prior year period. Segment revenue breakdown: market data licensing, 13 million bucks, up 2%, continues to be a highly resilient, recurring revenue driver. Its corporate services, 13.2 million bucks, up 19%, driven by pricing updates and a steady influx of companies listing on top tiers alongside upgrades into the new OTCRD classification. OTC Link, 8.6 million, it's up 30% by an increase of transaction volumes, with average daily trades climbing significantly year over year. Its net income expanded 17% to 7.1 million bucks, achieving an operational profit margin of 25.5%. Demonstrating clear capital return velocity, the company distributed millions in total capital back to investors over the quarter through a combination of open market share repurchases and regular dividends. The board positioned the quarterly dividend baseline at 30 cents per share, which sits alongside their historic distribution of significant year-end special cash dividends. Well, guys, that was it. I hope to have given you a overview of the largest stock exchange operators in the world. And if this was useful, feel free to reach out. If you have any questions, or would you like me to talk about something in my next video, feel free to put it in the comments below. And as always, feel free to reach out, guys. I'm here for you. Peace out.